Hello, dear viewers. Hope you all are doing well. Welcome to Revision Time. In our previous video, we have studied about classification of accounts and we classified it as modern approach and traditional approach, under which modern approach and traditional approach of classification of accounting. Under modern approach of accounting, we studied about classification of 5 categories of account for the purpose of recording the transactions, and those were assets, liabilities, capital, expenses, and revenue. We studied the rules of debit and credit related to these 5 categories of accounts. In asset, it was increase in asset is to be debited and decrease is to be credited. Liabilities, increase in liability is to be credited and decrease in liability is debited. Capital, increase in liability is credited and decrease in capital is debited. Expenses, increase in expenses is debited, decrease in expenses is credited. Revenue, increase in capital is credited and decrease in revenue is debited. So this was how we classified the categories of accounts under modern approach of accounting, and these are the rules of debit and credit under modern approach of accounting. Next, we had classification of accounting based on traditional approach of accounting, and they are classified as 3 types, that is personal account, real account, and nominal account. And there are rules of personal account, real account, and nominal account, which is termed as golden rules of accounting. For these rules are very important for recording of transactions, helps us to understand how to classify the account, how to classify the asset liability and record it in our books of accounts. So let us read out our golden rules of accounting. For the personal account, it is debit the receiver and credit the giver. For real account, debit what comes in, credit what goes out. And for nominal account, it is debit all expenses and losses, credit all incomes and gains. And here we know that personal account is nothing but account which is related to the person. Real account is the account of assets and liabilities, and nominal account is all related to expense, losses, incomes, profit and gains. In our today's video, we will be studying about journal entries. Before that, we will be understanding what is a journal, what is the format of the journal, what are how we record the transactions in journal. Let us start. So, what is journal? Journal is nothing but a book of primary entry, original entry, first entry. Book of first entry is called journal, or it is also known as book of original entry. Our journal is the book of first entry. The practice of recording the complete record of each transaction in one place and links the debit and credit of each transaction. So, we can say that this journal entries follow the double entry system of recording. They record complete transaction, both the aspects of an transaction, debit and credit aspects. So journal entry is a primary book. The information in the simple journal entries is transferred from these account to different accounts. So so it is known as primary book or a original entry book. Here we maintain the records as per chronological order, that is as and when it takes place. Next, this journal entry is the foundation of all accounting, because this is where the accounting starts, because here we start recording our transactions for the first time, and from here it is transferred to different ledgers and all. Next, this follows the double entry system of accounting. Now, if we speak about the format of journal, it goes like this. The standard format of journal is that we have transaction date, particulars of business transaction, that next we have ledger folio number, debit entry and credit entry. So this is the format of journal entry. This is how our account looks. First we have the heading which speaks about that entry, that is journal entry. Next we have date. In the date column we write when the transaction had taken place. Particular, it speaks about the particulars of business transaction, the summary, the accounts related to those transaction. Next, ledger folio is nothing but the number, page number, which has to be affected in our ledger. Next, debit entry is the amount which is to be debited. Credit entry is the amount which is to be credited. So now let us read out some examples of transactions, understand what all accounts are affected in a particular transaction, apply rules of our golden rules of account and record journal entries. So our first entry is Rohit started business with cash rupees 5 lakh. Since Rohit is a owner, he is bringing capital into business, and as a owner, if he brings capital, it is termed as Rohit's capital, correct? And he is bringing cash into business. Now, if we apply here, we have two accounts which are getting affected in this transaction, that is cash and capital. Now, when we speak of cash, we know that cash is an asset which can be touched and seen, and this comes into our real account. And here, capital. Capital is nothing but related to human, and this comes under our personal account. Now, every time when we are recording the transaction, when we are classifying the transaction and understanding about the accounts which come into effect, we have to think it from the business point of view. Correct? Now, when we are thinking it from the business point of view, started business with cash. For business, cash is coming in. Now, when we think of real account, we know that real account tells debit what comes in, credit what goes out. Now, cash is coming into the business, so cash account is debited. Now, when we think of capital, capital is of personal account, and our rules of personal account are debit the receiver, credit the giver. Correct? Since Rohit is giving money to the business, it's his capital, he will be credited. Rohit account will be credited. This is our journal entry. This is how it is recorded. Cash account is debited. Rohit capital account is credited, and for credit we record it as 2, and for debit we record it as DR, that is debit record. And our credit entry is classified as 2, and debit amount, credit amount is to be recorded in our both respective columns. Next, here we give a narration that which explains about the particular transaction. Here, being Rohit bought capital into the business, and here we write date of the transaction. It might be some 31st of March. This is how we have to imagine the transaction with the point of view of the business and understand which rule of account is to be applied on that accounts, and then record our journal entries. Let us look into the next example. So our next entry is purchased goods for cash worth rupees 10,000. Here, when we read the transaction, we can understand here two accounts come into effect, that is purchase account. We are purchasing goods, correct? And next one is cash account. Correct? Cash account. Now, we have to remember that purchase account is our nominal account which speaks about expenses, losses, gains and income. So, purchase is our expense. Next, cash account, we know that it is our real account. Now, purchase is our expense, and according to our nominal account, it comes under nominal account, and here it comes under real account. In our nominal account, we have studied that debit all expenses and losses, credit all incomes and gains. Here, purchase is our expense, which means that purchase account is debited, and cash, which comes in real account, our real account states that debit what comes in, credit what goes out. In this entry, when we are purchasing something, we are giving them cash, and in this entry, cash is going out of the business, which states that cash account is to be credited, because debit what comes in, credit what goes out. Cash is going out of the business, it is credited, and purchase account is under our nominal account, which states that debit all expenses and losses, credit all incomes and gains. Because of this, purchase account is debited and our cash account is credited. So this is how we record our journal entry, that is purchase account debited to cash account. Cash is nothing but our credit entry, to is our credit entry, DR is our debit record, and here we write our record our debit and credit entry, that is rupees 10,000. Then we give the narration of that transaction which explains about how the transaction had taken place, that which says that being goods purchased for cash. So our next example is goods sold to Priya for 16,000. Here we have to always remember that when we are speaking of goods, it's either whatever purchase or sale. When we are recording in our books of transaction, we have to record it as purchase or sale when the word goods come into the effect. Here we can see goods sold for to Priya for rupees 16,000. When goods is mentioned in the transaction with purchase or sale, when we are recording our transaction, we have to record it as purchase account or sale account. We cannot record it as goods account. Correct? Purchase account or sale account. Another transaction to put on light is goods sold to Priya for 16,000. Now here we see that there is no mention of cash. So this is not a cash transaction and this is a credit transaction. When the word cash is mentioned in our transaction, it is to be understood that it is a cash transaction and cash account comes into consideration while recording our journal entries. When the name of the buyer is mentioned in our journal entry, here it is Priya, so it is Priya account. Cash account does not come into consideration and this is our credit transaction. Similarly, if we think that goods were sold to Priya for cash, rupees 16,000. Here again for cash, which means it is a cash transaction and cash account comes into consideration. So this is to be remembered when goods come into our transaction, whether with purchase or sale, we cannot write goods account. We have to understand it is a purchase or sale and use purchase account and sale account. When cash is not mentioned in the transaction, it means that it is a credit transaction and cash account does not come into effect. Now, goods sold to Priya for 16,000. Goods sold, which means sales account. Next, to Priya. We are selling it on credit. So, Priya's account. Correct? Now, Priya's account is a personal account. We know that it's a personal account. Sales account is our nominal account. So, our personal account, our rules are debit the receiver, credit the giver. Now, here Priya, we are selling goods to Priya. In that sense, Priya is receiving the goods and she will be debited. Debit the receiver. Here, sales account is our nominal account and our nominal account states that debit all expenses and losses, credit all income and gains. We know that sales is our income. With that effect, sales account is to be credited. Sales account is credited and our Priya's account is debited. So let us see how the transaction is to be recorded. It is as sales account debit to Priya's account with the debit and credit entry, that is 16,000, 16,000. And we have a narration which speaks about, which explains why the transaction had taken place, that is being goods sold to Priya on credit. So this is how we have to visualize the transactions from the point of view of business, understand what is coming into business, who is the giver, what is going out of the business, what are our expenses and losses, and then apply the correct account and then classify the account and record them into journal entries. So these were the few examples we studied today, and more examples we will be taking up in our next video to understand which account, how it is classified, what rule is to be applied on. So if you have any doubts regarding today's video, how to classify and how to record in the books of account, you can post them into our comments. We will solve them at earliest. If you have found our video informative, please like our video and subscribe to our channel. Until then, happy learning. Signing off.